Good morning or good evening, wherever you are in the world. My name is Kyle Rottos, Senior Market Analyst at Capital.com. I'm with Dani Hathorn, who is my counterpart based in the UK, also Senior Market Analyst at Capital.com. And this is the Market Mondays webinar. Dani, great to have your company again. Good to see you. How are you going?
I'm good. Good morning or afternoon, everyone. Welcome back to another edition of our Monday webinar.
Certainly. Before we get into the topics that we'll cover today and the substance of things, we'll just cover off very quickly the risk warnings. First, I'll say that anything that you hear here today is of a general nature only, and it doesn't take into consideration your personal circumstances. So please consider whether CFDs are appropriate products for you before trading. And of course, if you require financial advice, seek out that from a certified professional. And Danny, you've got something to add there, of course, with a bit of a spread betting flavor there as well.
Yeah, just the same. For those of you in the UK, we also offer spread betting as well. So just be aware that when you are trading with Capital.com, that you are aware of the risk that these products carry, both CFDs and spread bet, just to make sure that you are well informed of how to use them and the risks.
Most certainly. Okay. We'll look at what we might discuss amongst some other things today, because obviously there are a few stories moving markets at the moment, but we will talk about the FOMC and how that rolls into some of the data that we're getting in the week ahead and how that informs obviously interest rate expectations and financial market pricing going forward. Inflation, like I said, Bank of Japan also was last week, managed to shake things up in the Asian session, although the longevity of that move was not particularly long at all. And then there was also the Bank of England, which Danny will discuss as well. But Danny, maybe I'll pass it over to you briefly, just with a high level for a high level overview of just the FOMC decision, because obviously we've hit what record highs on Wall Street, but we have seen the dollar rebound a little bit. Gold's shuffled around somewhat, and there is still obviously speculation about what the rate path forward will look like. In
Yeah.
particular, how deep will interest rate cuts be?
Yeah, I mean, realistically, there was a lot riding on this meeting, but the outlook hasn't changed that much in the sense that, and we talked about this, Carl, in the past, how there was so much asymmetry in the risk. The risks were very skewed to the fact that markets were heavily priced in of a dovish outlook, right? And they were expecting that the Federal Reserve was going to cut rates at the meeting, which did, of course, happen. But then they were going to signal continued easing in the next few months as a way to adapt to specifically the weakening labor market in the US. Now, that did happen. We did see the cut, and we did see the Fed hint towards cuts coming, but the outlook and the view wasn't as dovish as markets were expecting. That's why we saw a little bit of a wobble in equity markets on Wednesday, just after the meeting. However, when we look at the outlook itself, it's still dovish. There's still cuts coming. And Powell's commentary did shift from focusing on persistent inflationary pressures to focusing more on the labor market and that part of their dual mandate. So there was that shift, there was that change of tone that markets were expecting. The dot plot was a little bit less dovish than hoped to some extent. And I think one of the key takeaways was the voting structure. And we'd seen in the prior meeting two dissenters for a larger cut. We were expecting to see three at this meeting. However, that didn't happen. The only one that actually voted for a 50 basis point cut was Stephen Myron, which essentially is a placeholder for the US government. He's been placed there and he's expected to be ultra dovish. He's also in the running to be one of the Fed governors next year. So that was a little bit of a shock to the markets, I think. It kind of showed this view that, maybe the Federal Reserve was taking it a little bit slower and being a bit more cautious. The fact that Christopher Waller and Michelle Bowman, which had voted for larger cuts in the previous meeting, did not decide to push for 50 this time or last week. That did seem to be a little bit of a shock to markets. And I think that's where we saw a little bit of maybe that less dovishness coming through. Because they were essentially realizing, okay, maybe the cutting cycle isn't going to be as quick and as urgent as markets had priced in. So that was maybe some of that uncertainty coming into the market. However, looking forward, and the reason why equity markets continue to push higher is the fact that cuts are still coming. There's no denying that. The data seems to be moving in the right direction. We will have the PCE data, which we'll talk about in just a second. This week, we are, I think, expecting to see a little bit of a rise from what we saw in the previous month. So that could maybe throw a little bit of a spanner in the works for those dovish hopefuls. But nonetheless, easing is coming. And also, we talked about this, Carl, as well. The fact that the Fed governor is going to change, I believe in May next year. So what, in about 6 months' time? And markets are expecting that the person that's going to follow is going to be effectively much more dovish than Powell. So even if Powell disappoints from now until then, markets kind of have this hope that, well, that's going to be a new slate, a clean slate, and all is going to be good from there. So that's why I think we're seeing some of that bullishness still in equity markets. Carl, over to you. What do you think?
Yeah, I agree. I think there is a couple of things going on. First, the markets, I think, were very much welcoming the fact that there was an extra cut implied for 2025 in the dot plots. And I think as you were watching the decision, the initial rally in equity markets and the sell-off in the dollar and the run-up in gold above 3,700 was definitely on that part of the equation. The cut was announced. Those were the first sort of figures to be digested, and we saw sort of risk on, so to speak. Things were tempered just a little bit because what we saw in the dot in 2026, or the median dot in 2026, was one, a fairly significant distribution when it comes to the projections from the board members from board members, but also that there was only, again, one cut discounted or projected for 2026 when market participants have been pricing in basically 75 basis points. Color was added to that with Powell's press conference, which sort of started off with a little bit of a sell-off because he was talking sort of about, risk management cuts and striking a less cautious tone in the past, but still a more cautious tone about, cutting too aggressively than perhaps the markets were hoping for. But there was very clear recognition of the shift in the balance of risks. And then what I assume, and this is probably a little bit more of an inference that I'm drawing from the price action here, is that, like you said, Danny, Powell's time as chairperson ends in May 2026. He's almost certainly going to be replaced with someone that is going to be almost a proxy for the White House, or at the very least, someone who is quite dovish. Given that's the case, we're talking about a sort of a tale of two Feds here. The Powell Fed that could progress along the path somewhat implied in the dot plots as we know them from last week, and afterwards, which may, and this was where this sort of Stephen Myron situation comes into things and becomes quite interesting, which may look a lot more like the Stephen Myron dot than it does the median dot. And I'll just raise just the Fed Watch tool because we looked at it last week, and it's obviously just a great tool to push anyone towards to give a bit of a picture of what the markets are expecting for future meetings. As you can see here, October, 91% chance of a rate cut. From there, December is priced in at about an 80% chance. So a bit of an asymmetric skew, but clearly still room for equities to move higher on the prospect of, maybe some tame inflation data leading to the markets pricing in a higher chance of a, cut in, or marginally higher chance of a cut in both October and December. But if we go down to the dot plot chart, this will update for the most recent projections. You can see here the median dot is somewhere around the mid threes, which would imply two more cuts or thereabouts for 2025. This is the Myron dot though, and this is where markets are pricing in the federal funds rate to be somewhere around the end of next year, well below where the median dot is for the broader FOMC as it's currently made up. So what I sort of infer is that this dot here, which basically implies 75, maybe 100 basis points of cuts to go for this year, kind of discounted. But the markets are saying, well, there's a very good chance that we could get rate cuts somewhere below 3%, or much more than the one being forecast by the median dot at the moment. And as a result, we've got equities kind of rolling into that news on the basis that things could be a lot looser, a lot more accommodative. And if you do look at the Fed's estimates of a neutral interest rate, it is somewhere around 3.5%. The divergence here is that the current Fed is projecting rates to come back to somewhere around neutral and be on a fairly even keel. Myron and Powell's replacement could be looking to push rates into stimulatory territory, and equities are pricing in that sort of upside risk to that. So it's a really interesting dynamic, but I would call it really just a tale of two Feds. And that's why, well, we've got equities probably responding to that side of the equation. And then you've got yields, the dollar yields and initially gold responding to the other side of the equation, which is, a bit of a lift in yields because the dot plots were a bit higher than expected.
Yeah, I agree. The momentum's been pretty interesting. As I said, we do kind of have that shift in the dot plot and expectations. But when it comes down to it, when it comes to markets and what to look out for, the Fed has kind of reinforced the view that there's easing coming, but also creating a little bit of uncertainty because I guess now the question is how much of this is skewed by political influence and how much are we actually going to see now until May when Powell's term as chairman ends and what's going to happen later. So again, maybe a little bit of uncertainty creeping in. We can see in the equity markets, the S&P 500 here actually ending off the week pretty positive once again after the Fed. We did see, you can see there on the candlestick on Wednesday, that little bit of a wobble, which actually was marking a new low for the week, but then recovered throughout the end of the session and actually pushed higher on Thursday and Friday. The start of the week so far, a little bit uneventful. The futures are pointing towards a pretty flat open, if anything, skewed a little bit to the downside. Kyle, I think in Asia, we've seen a little bit of a disappointing equity market today, even after that news of China and the US supposedly getting closer together. I think from what I've read, that a lot of it having to do with the fact that Trump is potentially going to visit China in October, but there seems to be a lack of commitment to actually see any progress moving forward. What's your take on that?
Yeah, just no follow through. I just don't think the market's picked up on the news today with any kind of interest. I mean, obviously, it was responsible for pushing Wall Street to its highs on Friday night, as well as that Intel news with Nvidia, and obviously just the follow through from the Fed. But there really wasn't much of a take up this morning in markets of the potential visit by Trump to China. There's the argument that there needed to be more sort of substance behind things, and that's why investors didn't buy into it. There was also the argument that Xi had also made some comments shortly after that this was announced about, more or less, putting the US on notice to make sure that it brings its best behavior and brings something to the table, and that the Chinese are somewhat, cautious about the US's intentions. But it does look a little bit fascinating to start the week because we are seeing cryptos off, interestingly enough, and altcoins in particular. We're seeing some stocks pull back a little bit, or stock indices pull back a little bit. So there is perhaps, just to start the week, that question of whether the momentum is just cooling a little bit after the run that we saw at the back end of this week. And perhaps if there's a couple of days of blowing off a little bit of that froth off the top of things, given just some of the signals that we're seeing in markets here.
Well, I think there's no question that valuations remain stretched, right? There hasn't been in the last few months. I mean, we've been concerned a few times about how equities could perform, but they've always seemed to bounce back, and there hasn't really been a significant correction to kind of justify some of the price levels that are out there right now. So it's normal, I think. I think there's a continuous question of when is enough going to be enough, for some of these valuations, and when they become so expensive that they become unsustainable when you're looking at the price to earnings ratio and how expensive they've become. But they continue to move higher, and there isn't anything fundamentally too challenging right now. We can talk about, we have a question actually on, all of these cuts and how they can, essentially, will they be bad for inflation risks? And on the offset, yes. I mean, if you're thinking specifically with the data coming out this week, which could potentially point to continued upside in some of these price pressures, if cuts are coming, if they're done unmeasured or in a way that's not trying to balance the risk of inflation, yes, they can be negative for inflation because a softer monetary policy, a softer financing condition can lead to more spending in the economy. However, we are at a point now where some of these indicators are signaling that consumer spending has slowed significantly, whether that's in retail sales, whether that's in growth in the economy, not to the point of a recession, but yes, to the point to justify some easing in rates without going too far. We have to say that the Fed has been very reluctant to cut in the cutting cycle, which essentially has been going for the last 12, 13, 14 months now. The Fed is taking it very slow, and that's allowed it to be at a point where it's able to ease its policy without risking too much runaway inflation, at least at this point. However, it is something to take into account. There are people that are skeptical. Some of them are actually on the voting board for the FOMC, that cutting too much too quickly is going to lead once again to inflationary pressures and making the Fed be behind the curve once again. So yes, there is that risk and it's something to watch out for. But at this point, especially if they take it easy, which clearly last week's meeting signaled they are, as the majority voted for 25 over 50. If they take it as a measured approach, then it's likely that they are going to balance the risks of inflation as they go. Right, Kyle?
Yeah, no, I mean, I think there's obviously a market discounting the risk of inflation getting away from the Fed if they cut prematurely. And, that's probably one of the reasons why we have seen that kind of curve steepening over the last few weeks in particular, is that not only is there the fear that a Trump loyal Fed chairperson will undermine the independence and therefore credibility of US paper, more or less. But there's also just simply the sense that a lower federal funds rate at a time where inflation could still be running at sort of 2.5% to sort of, close to 3%. And it has to be said, by the Fed's own projections now, they don't see themselves returning inflation to target until 2028, I think at this stage. It's another 2 years or so. That poses the potential that rates are cut prematurely, inflation takes off again, and that has to be discounted in markets. So without a doubt, I think inflation risks are still being discounted into prices. It's manifesting in the shape of the curve, and I think that's probably one of the big things to be fearful of, is that if, again, we do get, say, a Myron adjacent Fed chair after May next year, and their view is that the federal funds rate should be at 2 point something percent, in the high 2 point something percent, that is theoretically stimulatory policy and therefore should stoke inflation. So that needs to be discounted. And to be honest, when you do have that happening only in the short term, typically stocks rise with that drop in the front end until it becomes too difficult to ignore in the real economic data, and then the brakes have to be slammed and inflation becomes more volatile, interest rate policy becomes a little bit more erratic. And I would imagine that's probably why Powell wanted to highlight that risk management language coming through, that they're just going to try and sort of tap the brakes, tap the accelerator rather than slam their foot on the accelerator, to make sure that they don't lose control of things there. Also, another reason why I think gold's probably running as well throughout all of this, amongst the myriad of things that we could point to that's supporting gold prices at the moment.
Yeah, I think something to watch out for as well. It's not something in the immediate future, but something to highlight as well is, of course, the fiscal constraints in the US. In fact, there was news on Friday that they have I think it was the US Senate rejected a short-term funding bill to keep the federal government essentially funded on a short-term basis. So that means that once again, lawmakers are going to have to vote by the end of this month, I believe it is, which is the deadline, on whether there's going to be a government shutdown once again or not. This happens quite often, actually. In the last few times, they've avoided it in the 11th hour. And the government has voted to extend the headroom, the fiscal headroom that they have. But we do have to highlight once again, one of the issues that the dollar has been facing and has been leading the depreciation is the lack of or the concerns about the fiscal constraint in the US and how it deteriorates the outlook of the US government, but specifically the US dollar as a global reserve as well. So, as I said, not something that's going to be immediate. We still have a few weeks to go, but something to watch out for when we're looking at the US dollar, and of course, how this can affect several other assets, is how the US government is going to either avoid the shutdown, try and extend the headroom that they have, or try and pass a sort of bill that tries to correct some of this deficit that they have, which seems very difficult right now, given Trump and his views on spending and taxes. So, yeah, definitely something to watch out for. And of course, the US dollar has been correcting some of the losses that we've seen recently. Actually, from last Wednesday, we've seen this upside. Coming through likely from, as we were saying, there's two ways to read the Fed. You could view it as they're still dovish, they're still going to cut, there's going to be a new Fed come May, or you can read it as they weren't as dovish as expected. The median outlook on the dot plot isn't as far down as where markets are pricing it. Therefore, it was a little bit less dovish and therefore positive for the dollar. So there's definitely different ways to take this. Obviously, we've seen some rebound in the dollar, which is, of course, weighed on things like euro dollar, cable, euro, yen as well. But the outlook for the dollar still remains very, very complicated and shaky. And even though it seems some short-term recovery, it's going to be hard to break some of these key resistance areas when fundamentally there isn't a lot of backing.
Yeah, it should be a fascinating one to see if we push through, I guess, what is that, around 98 on a sustained basis, because I feel fairly bearish on the dollar just on the basis that I think that the US economy will continue to slow, and that will kind of obviously have the effect of diverging yields. The euro, the yen, which incidentally got a small boost on Friday with a little bit more of a hawkish Bank of Japan, which I think we'll have to see more of eventually just because of the inflation situation in Japan, leading to what will be, I think, a continued downtrend in the US dollar. But in saying that, I mean, that was, as we've already said, the interesting dynamic when it comes to the markets is that yields actually rose after the Fed decision because markets had to reflect the fewer cuts forecast in the summary of economic projections and was actually being discounted in the curve. Ergo, you had yields rising in the US dollar. The only counterpoint, this is where things get a little bit interesting here, is that we did see a lot of support coming through at 96, and we've got a lot of bad news priced in. Short positioning, I still believe, I haven't checked it in a couple of weeks, but I would imagine short positioning in the dollar is still pretty significant. So that can unwind pretty quickly and maybe send things the other way. But nevertheless, my view is still that the dollar is going to continue to weaken, but maybe a little bit adjacent to that because it is a part of the story, and we're going to get the question about it, just having a look at gold because it's making another run today just towards 37. There we go. We're through 3,700 again at another record high. Really, it's a runaway freight train at the moment, Danny. I mean, we can, I suppose, go into the kind of bigger picture stories here as to what's going on, but I mean, a lot of it's just really around interest rate cuts and then maybe to a lesser extent, sort of Fed independence in the short term.
Yeah. Yeah, I think we've said this in the past. That fundamentally, there is a lot of drivers for gold, whether you're looking at central bank buying, whether you're looking about diversifying away from a US dollar and expectations that the dollar is going to continue to depreciate. But the story right now is and has been about, rates, and the fact that we have confirmation of rate cuts that are coming is definitely obviously positive for gold as a non-yielding asset. Same for silver as well, even though it has industrial applications which also affect its price. But precious metals continue to move higher. Yes, maybe there are a few less rate cuts priced in, but at this point, it's not something I think gold is concerned with. The fact alone that rates were lowered on Wednesday, which practically is positive for gold, and the fact that more rates are coming and there was no kind of attempt to dissuade markets from that, I think is definitely positive for gold. Again, we run into the same question: is it going to get a little bit overbought? When we do tend to see rallies like this, a little bit of runaway, we do see some short-term correction. We saw that actually at the beginning of last week. But all in all, I think that the outlook, both on the short term and the medium to long term for gold, remains pretty positive. There's not really much you can say right now other than would you really want to be a seller in this kind of environment?
Yeah, I mean, we were talking and arguably calling the breakout for a little while, and when gold does break out, it tends to run pretty hard for a little while. Maybe Danny, well, it's 6:20, well, 25 past the hour. Maybe we'll throw things up to
Yeah.
any further questions, and if we don't get any further questions, maybe we can have a quick discussion about crude, and then wrap things
Yeah, I mean,
up for another week.
yeah, I mean, look, the Bank of England was pretty uneventful. There's not really much to say that's not, there's not really much forward looking in it. But other than that, just, the Bank of England left pretty much unchanged. The key question now, and something that will affect the UK economy going forward, is the concern about stagflation. Inflation continues to show upside pressures. This economy is slowing clearly, as was evidenced by the July GDP data. The Bank of England couldn't really much say, they couldn't say much to change that narrative. They're on a wait and see outlook. However, there is some interesting story about the US kind of pledging to spend some money in the UK economy via private companies, specifically in the tech and AI sector. Some of the big ones like Nvidia and Microsoft are expected to spend a significant amount of money in the next few years in the UK. So that's been pretty positive. It's a question now of how much of that money that was pledged will actually be spent, and also how much on the ground in terms of skill and resources and capabilities are able to actually keep that investment running. But yeah, not really that much exciting about the Bank of England, just to notice.
Yes, unfortunately. So, same old story. Just finally on oil, there wasn't too many developments in the actual energy complex, I think, over the last few days, but really noteworthy that we failed to really hold that rally and bounce off that kind of 62 mark, or actually it might even be a bit lower than that. What is that? Yeah, $61 per barrel. So there is still that dynamic where global growth is weakening. Obviously, the Chinese data that we got last week was pretty disappointing and suggests that its economy needs a little bit more stimulus. And there is still an OPEC that is planning to increase supply fairly or output fairly significantly in October, from memory, about 136,000 barrels per day. We're already in an environment where there's a glut building. It looks like on that basis, the risk is skewed to the downside. And if, 61 breaks, from a technical point of view, given that we have seen that sort of tested on a couple of occasions, then that could invite further selling there. I think that's probably where we can leave it,
Yeah.
Daniel. Do you think
I think the only
that's
thing I
appropriate?
guess more forward looking towards this week, we've got the PCE data, as we
Yeah.
said, expecting it to see a little bit firmer than previous months. Um, Watch out, I guess, for yields in the US dollar, how they react to that. Also, we may see a little bit of a wobble in equity markets if that data does come in stronger. I guess it depends on how far away from expectations it comes. I can't see it overheating too much, but it's always a risk to watch out for. Markets continue heavily skewed on the risk, on the dovish outlook. So again, there's that imbalance and complacency in markets, which could be caught off guard once again if that PCE data comes in a little bit stronger. So watch out for that. We may be in for a little bit of volatility towards the end of the week. Anything else, Kyle?
Yeah, I mean, only to add just the numbers there, 2.9% forecast. If it comes out with a three in front of it, that might be a bit of sticker shock. So, I mean, it has been a very low volatility environment. And just as a quick aside, we have, I think the move index, which is the equivalent of the VIX for the bond market, at lows we haven't seen since basically, the pandemic. So it's quite remarkable. But anyway, not much volatility. Watch out for that PCE, like you said, Danny. And then other than that, keep on keeping on, and well, join us next week, same time, same place. Tell your friends. Danny, have a great
Oh, yeah.
week.
We're excited to see you again next Monday. Have a great week, everyone. Bye, Kyle.